Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at 7 different companies that are Sharia compliant. They are dividend growth companies. Majority of these companies have 3% plus yields and they are all undervalued at this point in time. Since basically I've planned the video, 2 of them has slightly gone up, but majority of them are undervalued at this point. So I'm going to share with you guys, and of course if you are interested in knowing more about dividend growth companies and companies with high yields, I've shared with the community 30 companies, so 15 companies that are dividend growth companies, so companies that have a small yield and so on, and like 1% and so on, and the companies that have 3+%, that basically I shared with them the community recently. So if you want to join us, you can join us in the Patreon account where you get access to a lot of things, including the subscriber portfolio reviews, where you can send me your portfolios and I will basically go over the entire portfolio and give you my opinion, of course. So yeah, that's where we are. That's what we're going to do in today's video. I hope you enjoyed this content. If you are, just subscribe to the channel, of course, and share it with your family and friends. And yeah, let's get started. So as always, we're looking for the same more or less information. These companies have a growing safe dividends. They have excellent free cash flow. Some of them are growing their EPS really nicely, and all of them basically are undervalued. 2 of them have just slightly gone up, but majority of them are still undervalued. So I don't want to make the video any longer than it needs to be. So let's get started. And the first company we're looking at today is Medtronic. Medtronic is one of the biggest companies out there. It has a huge market cap. Right now we're looking at about $92 per share. Dividend yield of over 3%. The payout ratio 51%. So let me explain the payout ratio situation. The payout ratio is basically how much of the net income the company uses to pay us dividends. Okay, so anything above 60% we say is basically not safe. Anything below 60% basically we're happy with. Okay, once it gets to 90%, 100%, that's when we have a problem, because that means how on earth is this company be able to afford all of that money to pay us as shareholders. Okay, so the 5-year growth rate is something important to me. I normally look for 6%, 7% or higher, but this one has 5.3. The dividend streak of 47 years, which means this company is a dividend aristocrat. And no surprise, you're going to see some dividend growth company, some kings and some aristocrats in this video. Dividend safety is 99%. That's the highest any company can get. Right now they have a free cash flow of $5.1 billion, which is absolutely huge. They expected to grow earnings about 8% next year. That's 2026. Revenue growth expected also to be about 5%, which is what this company normally trades at. So this is company grows basically. This is how much they grow every single year, about 5% to 8% EPS. Revenue is more or less the same. Morningstar is saying right now the company is undervalued by 21%. So it has a 21% upside from where we are right now. $111 per share, $112 per share is basically where they think the price should be. Right now we're looking at about $92 per share. The next one we're looking at today, and in fact before we move on to Hershey, I just want to show you a fast graph example based on the normal estimates. If you bought this stock right now, you'll be making about 13-14% on your money. Okay, if you use the normal multiple for this company that has been trading over the last whatever years, you'll be making about 36% on your money basically year over year. Okay, Hershey is the next one, $183 per share, dividend yield of 3.2. Payout ratio 65%, so it's slightly on the high end. The 5-year growth rate of 13%. The dividend streak is basically 15 years, so they've got another 10 years to become a dividend aristocrat. Safety 80%, $1.8 billion of free cash flow right now. And free cash flows are important because that's the money the company uses to pay dividends. Okay, that's the money the company pays, uses to pay off any debt that they have. They acquire other businesses, buy back their own shares, and to basically grow their business, if you like. Revenue is expected to grow 3% and EPS is expected to grow about 4%. 14% upside from where we are right now. $209 per share is where they think the price should be. And now looking at fast graph, as you can see here, this is the expected the earnings to slightly decline and then slowly grow back. Okay, so if you bought this stock right now based on where it is, you'll be losing basically about 35% according to the estimates. Based on the estimates that is, and this is the estimates that we're looking at right now. And when we look at the normal PE, the where the company has been trading over the last whatever years, you might argue that's not realistic, but that's where, that's basically, I'm just showing you the figures. Okay, 24% basically, 24 PE. If we look at, you'll be losing still about 1%. So it seems a little bit expensive if you are using fast graph, but based on this, it seems about 14% upside. In my opinion, I would actually wait for a bit, okay, because I own this stock. I haven't actually added to it for quite some time, so you might just want to take your time and don't rush into it. Okay, so just maybe wait for another drop because it has gone up quite a bit over the last few weeks. So next one is EOG Resources, and this is a energy company, $119 per share, 3.5% dividend yield, which is absolutely amazing. The payout ratio is 32% and the 5-year growth rate of almost 28%. 7 years of increase in it, 82% safety, $5.5 billion of free cash flow. They expected the earnings to grow about 12%, revenue about 14%, 7% upside from where we are, which is very interesting. Oil companies are one of the, oil and healthcare and also consumer staples. All three sectors, all the companies that we looked at right now are down in comparison to, the high flying, technology sectors and so on. So if we look at now fast graph, for example, as you can see here, basically based on the 15 PE, we would be making about 71%. So your 10,000 will now become 17,000 USD if you invest it based on the normal estimates, based on the estimates moving forward, which is about that 14%, 13%, 12%, 14%, so on. Normal PE for the companies, for this company, by the way, if we use that, you'll be making about 38. Okay, so that's about $13,885 based on that 10,000 initial investment, so which is quite interesting. So both Morningstar and Fastgraph agree this company, it is a buy right now and it's still cheap. Next one is J&J, one of the biggest pharmaceutical companies out there, about 170 right now. Since I planned the video, it's actually gone up quite a bit last 3 days, and of course right now it is still fair valued, about sort of a slightly gone over the price they were expecting it to be, but still fairly valued. So again, over 3% dividend yield, 50% payout ratio, 5 years with 5.5, let's call it about 6%. Dividend still goes 62 years, so another dividend king. Okay, this one is about to come a king, this one is already a king. And like I said, kings are companies that have paid and increased that dividend for 50 plus years. Safety is at 99%, which is the highest you can get. $20 billion of free cash flow right now. Growth is about 4%, which is basically the low end. So 4 to 5 to, all the way to 10%. That's basically what we expected from this company. And as you can see, same goes for revenue. And like I said already, it's $164 per share is where they think the price should be. Now looking at fast graph as well, if we buy the stock today, we will be making about 16%, so $11,619 per share. So per annum, we'll be making basically about 6% on your money, which is quite decent. And if we use the normal multiple, okay, so that's based on 15 PE, but if you use normal multiple, which is about 16, let's call it 17 for this company, you would be making about 29% on your money, almost a 30%. So your 10,000 will become almost a 13,000 USD in 3 years. So 3 years, next 3 years, basically, because that's what we're using, the estimates that we're using. Okay, so that's the fourth company that we're looking at today. The fifth company we're looking at is another pharmaceutical company, Merck, which has gone down a lot, but recently, last couple of days, it has come back. So now $84 per share, 4% over 4% yield right now. The payout ratio 40%. The fee again, which is quite low. The 5-year growth rate of 7% and of 13 years of increase in that dividend. Safety, we're looking at about 90% and $17 billion of free cash flow right now, which is absolutely amazing. EPS growth, they're expecting about 9%, revenue about 5%, 32% upside from where we are. $111 per share is where they think the price should be. And based on the current estimates, as you can see, the stock is down a lot right now. If you bought this stock, you'll be making basically 98% on the top of your money. So basically your 10,000 will become 19,800 almost a doubling your money within basically 3 years by December 2027. If we use the normal multiple, it makes no difference because this is one of the companies that has basically traded more or less the same for the less, whether it's a normal PE or based on the estimates and so on. So you're still making $19,564 per share even if you use this. So it seems another great company that's undervalued so much, excellent free cash flow. They expected the earnings to grow decently, but then again, the only basically downside I will say is that patent for Keytruda wearing off very soon, and if that happens, anything can happen, of course. But yeah, that's the only thing I can think of. The next one that we're looking at today is the Canadian Natural Resources, $31 per share, 5% over 5.5% dividend yield. The payout ratio 54%, the 5-year growth rate of 23%, which is absolutely huge. Dividend streak of 23 years. This is not part of the S&P 500, but if it was in 2 years, it will have become a dividend aristocrat. 70% safety, which is really good. Again, dividend in terms of the free cash flow is not the greatest. I would love the company to have a couple of $1 billion of free cash flow because that will make it absolutely solid. They're expecting the EPS to grow about 5% and revenue to decline about 7%. Again, don't forget, basically energy companies, oil companies have basically very cyclical businesses. Sometimes they're up, sometimes they're down, and right now it seems one of the years. 68% basically down right now, or upside from where we are, which is $53 per share. Right now we're looking at about $31 per share. By the way, if you haven't not pressed that like button, what are you waiting for? Come on, because genuinely helps the channel so much. We can reach a lot more brothers and sisters. So press that like button. Right, so looking at the fast graph right now, if we use the normal estimates, basically, which is that big of a decline, and then about 34% in 2027. So 2025, 2026, that decline there. 2027, 34% based on the estimates. Now, if we look at that, can you see this? Okay, so your 10,000 will become 15,000. So your 53% are basically the total rate of return in the basically next 3 years, which is really good. In the next 2 years, in fact. Okay, if we use the normal multiple, okay, and if we look at this, 15%. So again, 11,558 is what you will be making. So if you bought this stock right now, you'll still be making minimum of 15%, if not higher. The final company we're going to look at today is Genuine Parts. This is one of the companies that have been on my short list for a very long time. Did own it at some point in the family portfolio, but sold it eventually. Right now it's trading $133 per share, 3.4 payout dividend yield right now. The payout ratio is only 52%. The 5-year growth rate is about 6%. And guess what? Another dividend king. 68 years of increasing that dividend. Safety is 80%. Again, like I said before, I would like to see the company have a little bit more cash. Okay, the free cash, in fact. EPS growth is expected to be about 10%. Revenue about 4%, which is fine. So since I planned the video, the stock has gone up just slightly higher. But again, it seems basically it's fairly valued according to Morningstar. And checking fast graph, as you can see here, 15 PE, we will be making about 11% per annum, or in total, or about total annualized rate of return of 4%, almost 5%. So your 10,000 will become 11,158 in by the time we get to the end of 2027. Now, if we use the normal multiple for this company as well, not far off from where we've seen, about 33% upside from where we are. $13,378 per share is where you should be making. Again, remember, all of these are estimates. This can easily change. Anything can happen. This is based on where the company has been trading over the last 5 years and so on. So you have to take that into consideration when you look at this. But these are the 7 companies I want to share with you guys. 2 of these companies have slightly gone up since, but majority of them seem very much undervalued. I like the fact that they have a safe growing dividends. They've got excellent free cash flow, majority of them. They're expected to grow basically high single digits, some of them. And yes, we'll see how they perform over the next whatever years. I'm not saying go away and buy them. Now, I shared, like I said at the beginning, 15 of these companies with basically the community here, as well as another 15 stocks, okay, that are dividend growth companies where they trade in about 1% and they're very safe, but they're growing a lot and they have excellent free cash flow. And these two basically things are basically the selling point for these companies. They're growing it really nicely. They are very, very safe when it comes to the safety. They have excellent free cash flow. And when it comes to revenue side of it and the EPS side of it, they're growing fast. Now, some of those companies were not basically undervalued at this point in time. As you can imagine, some of the biggest companies in the S&P 500. But go and check that out, inshallah, if you would like to get access to that and a lot more, inshallah. Now I'm going to stop the video here. Before I do, please, it takes a lot of time and effort to put these videos together. If you can, like the video, subscribe to the channel, share it with your family and friends, that would be absolutely amazing. So yeah, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.